Welcome back. The next section we're going to cover is paper trading, the Option IQ software. We're going to be talking about two separate things. We're going to be talking about how to paper trade. That means that you're actually trading something that is still currently live in today's market. We're also going to be talking about back testing. Back testing is when you go back in time and choose to test a specific period of time and actually see how the trades during that period of time worked out. So we're going to give you the opportunity to do both things, and we're going to cover that in this section of the training. Once again, because we're going to be talking about actual trades, I've brought up the standard legal disclaimer that we talked about earlier. Everybody understands that trading involves risk. And I've got a new disclaimer as well. This is called a hypothetical results disclaimer. And essentially what this means is some of the results that we're going to be looking at are based on end-of-day data. We're talking about the end-of-day prices that you have in the market when the market settles up at the end of the day. So because we're going to be looking at those prices, our results, our actual results, if we're doing this ourselves in a live trade, could be more than or less than the results that we see here, simply because they're using the data from the end of the day to calculate all of the paper trading. They're not using the live data. The live data is only going to be used when you're placing a live trade. So again, your results will vary a little bit. They might be higher or lower than what you see here, but it shouldn't be a significant difference. So that's what the hypothetical results disclaimer is. All right, so let's talk about the simple and basic set of rules that we have for trading the Option IQ software. We're going to go in, I'm going to pull up the software right here on my screen so that everybody has an opportunity to actually see how to do this. So we're going to demonstrate this as well. But first and foremost, I want to just cover the basic slides before we jump into the actual trading software. So entry rules. We have a set of rules for getting into a trade, which I want to address first. And this particular slide is titled as rule number 1. This rule is that we set trades, or we actually choose trades from the software. These are trades that have already been set up for us, but we choose trades that always have a 9.4% probability factor or less. So the rule is set trades with less than or equal to 9.4% probability factor. Okay? Remember the probability factor we talked about in an earlier segment today. The probability factor is that little number that we're using. So when we get into a trade, we want to make sure that we always have less than 7.4 on the top and 9.4 on the bottom. Less than or equal to 9.4 on the bottom. So less than or equal is kind of the cardinal rule, and 9.4 is what we'll never go over. But right now, with the market trending up, which it has been over the last 5 years, we're using 7.4 for the top side of our trade and 9.4 for the bottom side of our trade. So again, that's what the P factor is going to do. It's going to tell us where to get in, it's going to tell us when to get out, and it is mechanical, and it's made up of other indicators that we've combined together. So again, it's not personal opinion, it's actually data from the live market. Okay, so if we're entering a trade with our P factors, here's how it's going to kind of work. We're going to have the market price, which you can see here on my slide. So whatever the market price is for that day. Now this is the market price for the S&P Futures Index, because that's where we're going to be trading the options on that contract. So whatever that price is, we'll call that 1850 for this example. The program's going to go out, or the software, and it's going to identify what trade boundaries fall within the probability factor rules. So before you actually have the trade, set up for you so that you can actually choose it and go ahead and set it in your own account, the trade actually is being set up in the back end of the software and making sure that it follows all of our rules. So number 1, you'll see here that with the market at 1850, the software is telling us to sell a 1940 call option. Now I know you guys have had a little bit of exposure to what options are and how they work. This particular option that I'm selling here at the less than or equal to 7.4% probability factor is a call option. So we're going to sell one call option at that level, and because the market's at 1850, doesn't look like there's a good chance the market price is going to increase enough to cross over or go above that 1940 price. But keep in mind, there is a 7.4% probability that it will, okay, roughly in this example. Also on the bottom, we're going to sell a 1710 put option. So this is different from what we're doing up on the top. We're doing a put option down here on the bottom. And the put on the bottom, the rule that we're going to follow is always less than or equal to 9.4%. So for this example, we're just going to assume that the top 7.4 and the bottom's 9.4. So again, the probability of this market dropping from 1850 and going low enough that the price goes below 1710 is not very likely, but there is about a 9.4% probability that that could happen. Okay? So that's how we're going to enter the trade with those P factors. Now, having said that, we are never going to set a trade at one of these lower strike prices. And the reason we're never going to enter a trade at one of these lower strike prices on the top or higher strike prices on the bottom is because we'll have a tighter trade, a more risky trade, where the chances of the market going up or down and crossing those boundaries is a lot greater. So we're always going to default to these rules. That's based on how the software is set up to work. We're trying to get you as far away from the market as you can be on both sides, where there's a small chance that the market's going to get there during your trade. All right, so what that means is we know we can't go both ways at the same time. We're only going to go one direction or the other. So in this particular case, we have roughly a 91% chance or probability that the market price, being today at 1850, will increase and decrease, but there's about a 91% chance that it won't go above 1940 or below 1710. So that's kind of the way to kind of look at the overall trade. Our current P-factor parameters, which I already touched on, but once again, this is for you to write down. With the current bull market, the P-factor parameters for our software today are set to call P-factor less than or equal to 7.4 and put P-factor less than or equal to 9.4. If these parameters are ever changed, you will be notified on the software. There will be a message that will pop up when you log in that will let you know that these things have been, or that these parameters have been adjusted. So if I logged into the software, and this is just a screenshot, but if I logged into the software right now, this is the Set New Trade page. This is the page we're going to look at to actually see what trades have been essentially recommended or set up for us to place in our account. So what you're going to see here on this screen is a number of trades. In fact, there are 7 trades that are shown on this screen. Now, what I've done is I've highlighted the probability factors so that when you're going in and selecting a trade, you can see exactly what those probability factors are prior to actually placing the trade in the live market. So at the top, you'll see something called preferred trades. Below that, we have another strategy called iron condor model trades, and I'll address that later. But this is the section. If you're looking at this page, that's where you're going to look to see what your probability factors are. Now remember, once you get into the trade, those are going to fluctuate every day. But this is telling you what it is prior to getting, or on day one when you get into the trade. So that was entry rule number 1. Entry rule number 2 is buy options for protection. Now remember earlier I talked about we don't buy options because, we've got to guess the direction, the magnitude, and the timing. Well, guess what? We don't buy options as our main strategy. We only buy options for protection. Okay, and that's a key component there to understand. So we're not going to be going out and buying options in an attempt to try and profit. We're actually going to be selling options in an attempt to profit, and we're only going to be buying options in an attempt to protect the options that we've sold. Okay? So rule number 2 is we're going to go out and buy options for protection. All of the Option IQ trades that you're going to see every day require you to purchase options to provide some level of protection in your trade. When we buy options, we limit our risk, and our system actually determines where to do it. So you don't have to go out and know where to purchase these options. The system's going to actually tell you exactly where to do it. We're also going to use our gross proceeds, or what I like to call our gross target profit. We're going to use money out of that gross to pay the price or the cost of buying these options. So when we go and sell options, we're going to take in a bunch of premium, and then out of that premium, that gross potential profit, we're going to actually use some of that money to buy options. And that's how we're going to cover that cost. The protection is going to limit the amount of risk that we take on our trade. And so let's actually look at an example. We're going to go back to the example I had just a moment ago. So here is that same trade. We are selling the 1940 call. We're selling the 1710 put. So the question is, where are we going to buy options to protect us? Now, for this example, I'm showing you what's known as an iron condor. That's the name of this strategy. So this strategy requires, for every call that we sell, it requires us to buy a call option higher or above the one that we sold. So in this particular case, I'm going up to 1960 is the price, and I am buying a call option for the same expiration month. So I've sold an option at 1940, and now I've bought an option at 1960. Now the reason why I'm doing this is because this limits my risk. You'll notice over on the right there it says the spread or the distance between these two lines equals 20 points. What that means is that our maximum risk that we're assuming on this side of the trade is 20 points of value. Now, we're going to get in and talk about points in a minute, but each index it has what's called a point system, and each point is worth a certain dollar value. So the S&P, the mini S&P index future contract that we trade on primarily here at Option IQ, those points are worth $50 each. So this particular trade is showing that I have set up my maximum risk on the top of my trade to be 20 points times $50, which equals $1,000. So my max risk on this trade is $1,000. Now, we don't ever want you to take the maximum loss and lose that $1,000, and that's why we're going to get out before we cross through the red line. But if we let it go through the red line and it continued and went all the way up and we let it cross the green line, and before the end of the trade it never came back down below, that's what we're actually putting at risk is $1,000 on that side of the trade. You'll notice down on the bottom, or the put side, we sold a put at 1710, and now we're going to go 20 points below that, again with the iron condor strategy, and we're going to buy a put at 1690. Again, as you can see, it's 20 points. So the max risk on the downside is 20 points times $50 a point, which equals $1,000. So this particular trade has been set up so that I have a max risk of $1,000 on the trade. Again, the market cannot go both ways at the same time. So for this particular trade, it could go one way or the other. However, the probability is that there's only a 7.4% chance that it'll actually cross this red one, or 9.4% that it'll cross this red one on the top or bottom. So again, we're hoping 90+% of the time we're staying within that range, and then we don't have to worry about that 20 points of risk. However, if we're not paying attention to our trade and it reaches our exit trigger or the exit alarm, the 40% P factor, and we don't get out, then we know what that risk is, and so we want to try and manage our trades as effectively as possible to try and avoid that potential for a loss. Okay, so that is how we would buy the options to protect us. Now again, this is for an iron condor strategy. This is just one of the strategies that we'll teach you over the next day and a half. However, this particular strategy is kind of our flagship strategy. This is what most of our members use when trading the software. They typically are choosing to trade these iron condor trades. So again, that is the protection. Rule number 3 is trade between 30 and 75 days remaining. Earlier, I talked about how time value, or how time is your friend, and how time value decays. So as time goes by, the option value actually decays or shrinks in value. Again, I pointed out during that demonstration and on that slide that the best time to enter trades is really if you're selling options, it's within that last 30 days. So if you enter at 30 and let it run all the way to the end, that's going to be your best option. However, we also continued to look at that, and I showed that if you backed it out to about 75 days down to zero, that's kind of the best time to be in the market. That's where you're going to get the most, that's where you're going to get the most time decay. So again, we're going to always select trades that have at least 30 days left and no more than 75 due to that information. Now, you will see trades on the software that only have 20 days left, 15 days left. However, we're recommending that you avoid those trades. The reason we've put them there is we do have some of our members that when they trade the software, they like to have shorter-term trades for whatever reason. And so we have allowed those to be there, but that is not part of our philosophy or our methodology for trading these types of strategies. So again, that's rule number 3. Now, if I'm on the actual software, which we're going to be in a minute, and I go to that set trades page or the setting a new trade page, and I'm looking for a new trade, I'm going to see a column that I've highlighted here in yellow titled DTE. DTE stands for days to expiration. In other words, how many days, and these are calendar days, how many calendar days does this trade have before it expires? And so that's where you're going to see that number. Here's where I would go in and make sure that whatever I select, it's got at least 30 and no more than 75. So you can see this 24-day trade we're not going to place. Everything else on this screen would be available according to rule number 3. Rule number 4 for entries, choose trades with value. Now you remember earlier on in the presentation, I spoke about always looking for value in our trades. We don't ever want to place a trade unless we can get paid a certain amount of value for the risk that we're taking on. And so as you see here, this actually kind of identifies or spells out what I mean when I talk about choose trades with value. We want to make sure that whenever you enter a trade that you look for what is known as the time value index reading. And I'm going to show you where that's located in just a moment. But we want to make sure that you don't ever take trades that show less than or equal to 0.30. We want you to take trades that are greater than that 0.30. Trades that are less than or equal to 0.30 TVI just don't offer enough premium, and we don't think it's a good idea to participate because you're not getting paid enough value for the risk that you're taking. So again, where do we find that? We find it over on the far right. So again, on the set trades page, when I pull it up and I'm looking at the available choices of the available trades that I can choose from today, I will notice the TVI column, time value index is what that stands for, and I can see that all of these are greater than 30. If I saw one over here that was that was less than or equal to 30, I would avoid that trade. Okay? All right. Now, those are the 4 entry rules. And I've got a couple slides here, and then we'll jump into the exit rules. This particular slide says, Preferred Trades is the title. Although all Option IQ daily recommended trades have probabilities of less than or equal to 9.4, depending on whether it's the top or bottom of the trade, we recommend always choosing one of the preferred trades. Preferred trades tend to have strike prices that have wider spreads than all the other choices below and meet all of the rules and guidelines. If I'm looking at the set trades page of the software, here is where preferred trades are. They're going to be the first trade listed. So when you go to this page, up at the top, as you can see on my slide here, the preferred trades are going to be listed. So right now there's 2 preferred trades. One has 45 days until it ends, and one has 59. These are both trades for the month of August, and they both have a certain amount of time remaining. Now, that is where we're going to, or that is what we're going to be able to select from. You'll notice the P-factor rule we went through. You'll notice the days to expiration that we went through. You're going to also notice over here the TVI that we went through. So again, this is where you're going to see all that information on that first page when you get into the software on the set new trades page. All right, so those are our entry rules. Pretty simple. All you've got to do is just make sure you follow them. There's no guessing or personal opinion. You're just following the rule as it's written. So what I want to talk about next are the exit rules and how you're going to exit a trade. Once you've placed a trade and that trade is live and active in the market, or maybe you're paper trading it, so there's no money at risk, but after you're actually in that trade, you're going to want to monitor the trade carefully. Now, we've created some automation to monitor the trade for you and send you alerts via text message or via an email. However, I want to teach you how to actually manage the trade. So once you want to, if you want to put the autopilot on to send you the alerts, then you can do that later. But for now, let's just learn the basic exit rules. So once I'm in a trade, I'm going to log into the trade each day, and I don't have to sit and look at it all day. This is not day trading, but I'm going to go in, for me, at the end of the day. So at the end of the day, when the market has kind of settled up for the day and then the futures market reopens, maybe you're getting home from work, you're going to go in and have a look at the trade. And here's what you're going to do. Number one, you're going to ask yourself, do any of the trades that I have, or this current trade that I have, or maybe I've got 5 trades going right now, do any of my current active trades have a 40% probability factor? And I'm going to show you how to check that, but it's very easy. As long as it does not have a 40% P factor, then rule number 1 has been covered. You do not need to exit because of risk. The only time you would have to exit because of risk is if you reach a 40% P factor on either side of the trade. Remember, you're looking at the P factor for the call options and the P factor for the put options. Okay? Now, it says here, once you reach that 40, you should exit the trade immediately, and when you exit, your trade will typically have a loss. So again, we've talked about that, but that's just so that everybody understands how that works. So again, if I'm looking at my trade, each day I'm going to see the call P factor and the put P factor for both, for each day that I'm in the trade. As long as I look at these numbers and I don't see 40, I put it away. There's no reason to exit because of risk. If there is a 40, I'm going to close it out. I'm going to get out of the trade. Exit rule number 2, take early profits. Now, this is something that I really like because this is something that you're going to want to kind of stay on top of. Anytime you can get into a trade and be able to achieve a certain amount, a large amount of the potential, what I call target profit, and actually be able to close it out with that profit, it makes sense to get out and take that money and try to get into another trade. In other words, the more often I can get into a trade, capture a majority of the profit, and close it out early, the faster I can turn that money over the course of a year and possibly be able to, have my money working harder for me and making a greater rate of return. So when trades have reached a large amount of the targeted profit, whatever you're supposed to make, if you get close to that, and it's happened in a short amount of time, in other words, there's not a lot of time left in the trade, there is a lot of time left in the trade, you've just barely begun the trade, then we would recommend exiting early and taking the profits and then moving into a different trade. As far as our automated exits go, we do have the ability to automate your exit if you're, depending on what broker you use, but we do have the opportunity to be able to automate that exit. Now, when you automate the exit, here's our recommendations, or what we would call our profit directives. If I reach 70% of the target profit and I reach it with still greater than 20 days left in the trade, we would recommend closing out the trade. If I have a trade that hits 80% of the target profit and I've still got greater than 10 days left in the trade, we would once again recommend getting out. And lastly, if I reach 90% of the profit and I've got less than 10 days, in other words, I'm at 95% with 2 days left, that would actually fit in here with the profit directive, and we would recommend exiting early. So you can set all these up as auto exits depending on the broker you choose, and you also have the ability to get out of any trade anytime you want if it reaches a profit that you're happy with. So if I'm just into a trade and it's reached a certain amount of the target profit and you're happy with that profit, it's fine to go ahead and exit it out. I've always heard the old wise adage that says no one goes broke taking a profit, or I think they say no one went broke taking a profit. So again, anytime you want to close out trades early with profits is not a bad idea, but these are some kind of, I guess, directives that we want to give you to kind of follow. These are some good guidelines to follow when you're trying to decide if you should get out early or hold the trade longer. Exit rule number 3. Now this is kind of an interesting rule, so I want to make sure that everybody understands the concept here. It's known as the proximity rule, and the word proximity means that you're getting close to something. You're coming within a certain distance of hitting something or reaching something. And the way this rule works is it says in the below in the example or the instructions, if the market price comes within 10 points of your sold option boundary within the last week of the trade, and that's critical, that's key, within the last week of the trade, you should exit immediately. Now, why would we come up with such a rule? The reason for this rule is sometimes you might only have a day or two left in the trade, and the market price might be getting close to your sold call or your sold put boundary. We want to make sure that it's not close enough that just with a regular day's actions, you know, the market blows through your boundary. We don't want that to happen. So again, this is kind of a rule that we added as kind of an additional caution that if the market is getting close to our sold call or sold put boundary and comes within 10 points in that last week, we want to get out of the trade so that we're not sitting there where it could possibly, in intraday action, the market could actually go through those boundaries. What I'm going to talk about next requires me to show the hypothetical results disclaimer again. I'm going to actually show what I call the math of the trade. What I mean by the math of the trade is I want to show you when you sell your options and you buy your options for protection, you know, how much can you potentially make when you sell them, and how much do you have to pay when you buy them, and talk about maybe what you would pay in commission. So how do all the numbers work? I kind of want to show you that before I take you into the software. That way, once we get into the software, you'll understand where the numbers are coming from. So in order to do that, I just brought up the hypothetical results disclaimer because I'm going to show you a hypothetical example of a trade. Here's an example of the trade that we talked about briefly a few minutes ago. And what you'll notice here is the market is at 1850. We sold the 1940 call option and simultaneously bought the 1960 call. We also sold the 1710 put and simultaneously bought the 1690 put. So all of these options were sold and bought for the exact same expiration day. Okay? And when we did this, each one of these options would have had a specific value. And whatever that value is, again, it depends on the live market when you get into the trade. Where are those values? So I've taken some hypothetical numbers and I'm just using them for this example to show you how this will work. So when we sold that 1940 call, it was worth 1.3 points. Now if you remember earlier, we talked about points being worth a certain dollar value. That dollar value is $50 on the E-mini S&P future index, which we're trading. So 1.3 points times $50 would give you the dollar amount. But we're going to sell that call, and right now it's worth 1.3 points. Simultaneously, we're also going to sell this put, the 1710 put, for 4.1 points. Now you'll notice we're selling them both at the same time. We're jumping in the market and we're trying to enter this entire trade all together at the same exact time. And based on the sophisticated trading software that they have nowadays, this entire trade can be entered as one trade. And you'll get the entire trade entered at the same time, or they won't enter you into the trade. So again, this is all happening at the exact same moment or time. So after I've sold and taken in some premium, I'm also going to buy my options. So the ones that I'm buying, the call, 1960, is going to cost just under a point. And the put, the 1690 put that I'm buying, is going to cost me 3.35 points. So now if I take all these numbers and we kind of do the math, we've sold a call and a put and taken in about 5.4 points. And then at the same moment, we've also gone out and we have purchased two options, a call and a put, for a total of about 4.05 points. So we've got to actually do the math to figure out what our net result would be. In this particular case, our net result is going to end up being about 1.35 net points. So when I take everything that was sold and the value or the money that I brought in for selling the options, and then I pay for my protection out of that money, I'm going to be left with a net of 1.35 points times $50, since this is the S&P E-mini Future Index that we're trading. So with the 1.3 net points, we also need to talk about the point prices. Now, I did mention this briefly, but again, each index that we trade has a assigned dollar value for each point that it moves up or down. So depending on what index, and again, primarily we're trading S&P. Once in a while, you might see a Russell trade, but these are the actual assigned values for each point. So these I guess, index contracts that we trade have not been assigned a dollar value for the option. They use a point system. And the point system is just an easy way to, I guess, to price the option. So each point being worth a certain dollar value. So back to the math. If we implement the point values and we multiply everything by 50, we come up with $67.50 for this particular trade as the net target profit. Now, we also have to remember that in addition to all of this, I need to make sure that I'm paying a commission. Now, depending on, what your commission rate is, I can tell you 5.25 per option, $5.25 per option happens to be one of the cheapest prices out there for this. You can see here $67.50 is the premium, and then to get in and out of the trade to cover what we call a round turn commission fee, which is how they're charged for these options on index futures, it's $21. So $5.25 times 4 options. I sold 2 and I bought 2. 4 options times $5.25 is $21. So when I work it out and I do all the math, that's $43.50 is my net target for this trade. That happens to be a 4.6% net return on the cash that I had to risk to put on this trade. And the time value index for this trade was 50.9. So again, if you look at this and you say to yourself, okay, so that's the amount. I had to put up just under $1,000. Now, let me explain that. If you remember our protective option, the green one, when we bought this one, we created a max risk of $1,000 on the top, as well as a $1,000 max risk on the bottom. When we enter the trade, really, the market can't go both ways at the same time. So they're not going to charge us $2,000 to enter this trade, or not, I shouldn't say charge us. They're not going to withhold as a security deposit $2,000 for this trade. That's something called margin. They're only going to make me put up $1,000 in margin minus my net target profit premium. So at this point, I only have to have about $966.50 in reserve, or what we call margin, as a security deposit on the trade. I have to have that much in my account to make sure that, or to allow them to let me place this trade. As long as I have that in my account, they'll let me place this trade because I am covering this trade's risk with actual money in my account. So they reserve that throughout the trade. As long as everything goes well and it stays between the boundaries, we would achieve a $43.50 profit, and the $966.50 would be released, and we could use it for our next trade. So that's where all the numbers come from when you're looking at the math of these trades. So now let's go and let's actually look at this same information, but let's look at it on the actual trading software. Setting a trade. What I'd like to go through now is the process of actually setting a trade with the Option IQ software. With the Option IQ software, we're going to do a couple of things. Number one, we're going to choose the preferred trade if it's available. That's what we would like everyone to do. When you log in and you look at what trades are available to set, we want you to choose the preferred one. Number 2, we'll review the trade's details to make sure it's a trade that we'd like. Next, we'll select what's known as the contract amount. In other words, how many of these trades do we want to do? Do we want to do just one? Or do we have enough money in our trading account to do 5? So we'll select the amount that we want to do. Okay, so we're going to select our test account number as it says, and then we'll click Set Trade. So let's actually go through this process. So I'm going to pull up the software, and I'm going to refresh it to make sure we're still logged in, which we're not. So I'm going to log in. And we're going to go to the Set New Trades page. And we're going to look at all the available trades that we have right now, and I'll walk you through this little process. Okay, so what we see is we scroll down and we see what's called the preferred trades. So at the very top of the screen, I see preferred trades. And underneath preferred trades, I see an actual trade that I could click on. Okay, then I go down and I see something called Iron Condor model trades. And I see a bunch of trades there. And I see something that says hybrid, and I see a bunch there. And there's actually some other strategies below that. But what I want to focus on right now is what we just talked about. So we go to the Set Trade page, which we're on, and we're going to go in and we're going to select from the preferred trade if available. Now let me just walk through the data that you're seeing on this screen to make sure everybody understands what's here. You'll notice you have at the top of the screen an index. So what index are we actually trading? It's going to tell us the E-mini S&P 500, and it says EOM. EOM stands for end of month. This option expires on the last trading day of the month. You'll see other options, week 4, week 1. You'll see one that doesn't show any weeks, which is actually week 3. So you will see what type of option it is that you're actually trading and what type of index you're trading on. To the right of that, you'll have days to expiration, or DTE. Again, this is calendar days. How many calendar days do I have until this trade ends? To the right of that, I have the puts P factor. This is as of right now. If I set this right now, in the market, this is where I'm starting out with my probability risk on the bottom of the trade. At the same time, go to the right, I have the call P factor, and I have 6.9% as the probability factor there. If I go to the right of that, I see a column titled Price. This is the actual price for the index that we're trading. Now remember, because we're trading options on an index futures contract, we're trading the month of October. So this represents the price for the futures contract that we're trading that expires the month of October. This is where the market is today, and if it decides to go up or down, it'll change daily and those prices will fluctuate. But that's where it is as of right now. To the right of that, you see another column with the heading Strikes, Put, Call. Strikes is a reference to a strike price, which is the level, the price level, where I'm selling or buying an option. In this particular case, this is telling me where I'm selling my options. If you look down below, you see the letter C. C stands for Iron Condor. This preferred trade happens to be an Iron Condor trade. So that's the type of strategy that we're using. The reason why it's preferred is because the spread on this trade is very, very wide. In fact, it's wider than all of the other Iron Condor trades below. So the first number I see is, after the letter C, is 1810 or 1810. That is the strike price where we're going to sell our put option on the bottom of the market. So the market's at 1991, and I'm selling a put down at 1810. Okay? At the same time, I'm selling a call up above the market at 2110. Okay? So that gives you an idea how wide this spread is. To the right of that, the amount of money that I have to have in my account in order to place the trade. Now, this money is not, you're not spending this money to get into the trade. You just have to have it in your trading account as a security deposit to be able to place this trade. In this trade, you need $941 in your trading account to be able to place this trade. To the right, you have net target profit. You'll notice after all of our costs have been stripped out. So we sell options, we spend some of that money to buy options, we pay a commission. After all of that is taken out, what we're left with is our net target profit. For this particular trade, that's $59 on an investment of $941, or the amount that we have at risk in the trade. Okay? As I go to the right, you'll see a number net on cash, 6.3%. What that's telling us is that this trade has 59 days, and over the 59 days on a deposit of $941, which essentially is an investment, I can make $59 if everything goes well. That $59 on 941 represents a 6.3% rate of return for the 59 days. Okay? And then to the right of that, we have what's called TVI, or Time Value Index. Again, this shows what my money's valued at over time. If I could do this same type of a trade every 59 days in my account and never have a loss, which is highly unlikely, I could achieve a 38.8% return within a year from now. Now, being able to place this same exact trade every 59 days is not realistic. There's going to be a different trade from now. It won't be the same one. But what it's telling you is the power of your money. If you were to achieve a 6.3% net return in 59 days and be able to duplicate that success every 59 days for 365 days without any losses, and by the way, this is not compounded, but that's what that return would look like. Again, we are not promising you that you're going to make that TVI. That's just giving you a ballpark idea of what kind of money you're making on the money that you have at risk if everything goes well. And then the last column on the far right is the trade column. You'll notice underneath there, I see the word paper. Now, I also could see the word live. In other words, I could set a live trade or I could set a paper trade. For this particular example, I'm going to take you through the motions, I guess, of setting a paper trade. Okay? So, if you remember what I said earlier, if we look at this one last time, this is the preferred trade, so this is the one that's recommended that we take. It has greater than 30 days and less than 75. The probability factors equal the rules. No problem there. They always will. And the TVI is greater than 30. Okay? So everything here checks out. It's fine. This is a trade that we want to place in our account. In order to be able to actually set this trade in our account as a paper trade, we're going to have to click on the little button here that says paper. So when I click that, the software is going to calculate this trade, and it's going to show me all the numbers, and it's going to show me a graphical representation of the trade on the right-hand side, and I'm going to be able to decide if I want to move forward with the trade. So let me walk you through this particular section. At the top of the screen, this is the name of this page. It's the Set Paper Trade page. Okay? We're setting a preferred trade, and we're setting it on September 2nd of 2014. You'll notice here the index that we're trading, E-mini S&P 500. The series is the 10th month of 2014. The expiration date would be October 31 of 2014. Time to expire, 59 days or calendar days. So that's what all the up top information is showing us. Now we see a blue, something in blue there that says sold options. So everything underneath that, these numbers and boxes, are applicable to the options that we have sold. That's all it's telling us here is what we've sold in this section. So you'll notice right now we're selling one option, one call option, at the strike price of $2,110. So this is similar to what we saw before, but it's really spelling it out for us. That strike price is 118 points above the current market price. The probability factor, less than or equal to 7.4. If I put my mouse over it, that's the rule. If I look at it, it's 6.9. So that's what it is right now, and it's less than the rule, less than or equal to the rule, so we're good to go. The point price over here on the far right, 1.45, that represents where the market finished at the end of the day. At the end of the day, when the normal market's closed and these futures indexes shut down for, I think it's 15 minutes before they reopened, This is where they settled. That was the fair value of the option. So that's not necessarily what you're going to be able to sell it for, but it's the best estimate that we can give you for paper trading. So as you look here, 1.45 times $50 a point, because this is the E-mini S&P. So that's what that option is worth if I were to sell it right now. If you look at the next line down, it tells me the same information for the put. One put, 1810, it's 182 points below the current market. Okay? And 9.1, the rule's less than or equal to 9.4. 9.1 is where we're at, so we're looking good. And lastly, to sell that option, we're going to get paid 6.1 points according to this settlement value. So they add the 2 points together. We get a total of 7.55 times 50, and that's where we come up with $377.50 as my net, or excuse me, as my gross sales amount. So that's what I'm selling the call and the put option for. If I sell those out into the market, that's what I'm expecting to collect from selling those options. Okay? Now let's go down to the next section. This is known as the bought options section. You'll notice we've got protection or outside protection listed next to it. So these are the options you're buying, not to potentially profit on, but just to protect the trade or the options that we've already sold. So in this particular example, we're going to buy a call option at $2,130 is the strike price, or what I would say $2,130. It's 20 points above the one we sold, and we're going to have to pay 0.85 points, just a little less than 1 point. We're also going to buy a put at $1,790, 20 points below the one that we sold, and that one's going to be a lot more expensive. This one's going to cost me about 5.1 points to buy that option. So if we add those together, we get 5.95. We multiply that number by $50 a point, and we get the buy price. So I took in $377.50. I've now spent $297.50 out of that $377.50. And again, at 5 1/4 per option times 4, I'd also have 21 in commissions that would come out of this. That leaves me with a net target profit after everything's taken out of $59 for this trade. So if everything goes the way that I want it to, the market cooperates, the market price stays between the options that we sold, we don't have to exit early with a loss, we will make the $59 in this particular trade. If I look below, there's my percentage net on cash, and there's the time value index number we looked at earlier. So this page essentially shows the same information we saw on the previous page, but the previous page was just kind of a high-level overview. This is where we drill down and actually look at the trade and decide if this is the trade we want to participate in. Now there's one other section I want to cover. Over here on the left, I have a number called cash required. Again, you saw that number on the last page. This cash required number represents what I have to have as a deposit in my trading account in order to be able to set this trade. Why do they make me have $941? Because my max risk on this trade, in the worst possible scenario you could ever think of, would be $1,000 on the top or $1,000 on the bottom. The only way you could lose that $1,000 is if you let the market price continue up and you didn't get out of the trade and you let it cross this red one and keep going. And if it crossed the yellow one and just kept going and going, you still would never lose more than $1,000. And the same is true for the bottom side of your trade. So we're taking that $1,000. Again, the market can only go one direction at a time. It's not going to cross the top and the bottom simultaneously. So all we're requiring is $1,000 as a deposit minus the net target profit that I expect to make when I set the trade, because that money will flow right into my account immediately. So 1,000 minus 59 equals $941. So that's what your cash required is. I also have a section here where I can select my account number. Each of you are going to select a test account. So I'm going to just choose a test account number right here in this account. And then lastly, I also have a trade name. So the way it's named right now, it shows the type of trade, C for Iron Condor. It then shows 1810 as the sold put and 2110 as the sold call. That is kind of essentially I guess, the easiest way to name your trade. However, I believe it allows up to 20 characters if you want to go in and rename it and personalize it. You could do that. Okay, one last piece before I actually set this trade in the live market. If you look over here to the far right-hand side, you're going to see the actual graphical representation of this trade. You'll see the red lines where we're selling our options, and the yellow lines are where we're buying our options. This is the graph of this trade, and it essentially shows me where I'm actually going to enter these positions. Now, the nice thing is the market in this trade is at 1991.8. So it's going to have to go up 118 points to cause us to have to exit the call at 2110, and it's going to have to go down 182 points to cause us to have to get out of the 1810 put. 182 points on the downside is like almost 9%. So there has to be a big drop in this market, or about a 6% increase, roughly, to cause us to go outside of those boundaries. So again, we are selling these options way far away in the hopes that they expire profitable to us and we make our money. To set this trade, the next thing we're going to do is we're simply going to come down where it says Set Trade here at the bottom, and we're just going to click this button, Set Trade. As soon as we set this paper trade, you'll watch what happens to my screen. It pulls up the trade that was just sent, or just set. You'll notice that there's really no details. The only details is that I got into a trade and had to pay $21 in commission, and that's where I'm at. So until the market starts moving up and down, we're not going to see anything on this graph here. We're not going to see anything on the chart. But as soon as we start going through this trade and watching it each day, we're going to see the market moving up and down. It'll be graphed out on this chart, and you'll also see each day and the information for each day displayed below the chart. So that'll help you kind of understand how to read what's actually happening with the trade. So I've now gone and set a trade, and it's going to always show up from now on under what's called active trades until it actually expires. So because this trade we just set is a paper trade, even though it's a paper trade, it's in the live market. We're watching it each day from now on, moving forward for the next, I think it was 59 days. So we're going to go in here every day and look at it under the active trades page. That's where we're going to that's where we're going to monitor this trade and be able to manage it. Next, I want to talk about monitoring the trade. Once you've got a live trade that you've actually placed in your account, this could be live with real money or it could be a live paper trade, the next thing you're going to want to do is watch that trade daily to make sure that the trade is doing okay. You want to make sure that you follow the exit rules that we talked about earlier if any of those exit parameters are reached. So, to monitor the trade, first thing you're going to do is you're going to go into what's called View Trade Details, and that is going to be under the Active Trades section. Once you get there, and I'm going to show you how to do this, we're going to review the P factors and we're going to watch for a 40% P factor. We're also going to review our daily profits. Again, if we reach a large amount of profit in a short period of time, we might want to look to get out of the trade early. And we're going to look for potential exits based on these rules each and every day. So let's go back now and let me show you how to monitor this trade each and every day. So here's the page that we left off on. This was the trade that we set, and because we basically just set it, there's no data down here for each day of the trade. If there was data, we would go up to this My Trades button and we would click on the Active Trades button. When we click that, that will bring up any trades that are still active in the market. And you'll notice here is the trade that we set, and we see essentially a little box with some details inside of it for that trade. Now notice on this particular trade I have the ID of the trade. Whatever we name the trade is shown here. In this case I just took the default name. We have the index, the date it was set, the price of where the market is now, the days to expiration. I have the P factors. I have my exposures. I have my target profit, and you'll notice the call exposure is 0 here because they only are requiring us to put up the put exposure for this trade, as they do in all of our trades. So that's why we're only using just that one side. The market can't go both ways at the same time. It's most likely going to go down, so they're making us put the money up for the put side of the trade, the security deposit. Then you'll see the target profit, you'll see profit loss, you'll see return on target, which is the return on what you're supposed to make. What percentage have you made of what you're supposed to make? Obviously, this is day one. And then you'll see your initial time value index, and you'll see your time value index today, based on where you're at. So for this particular trade, this is day one. We're just going to be getting into the trade today. We know that cost us $21. But over and above that, we have $59 that we're hoping to essentially make on this trade. That's our target profit after the $21 was taken out. So now, each and every day after today, we're going to log right back into this screen. We're going to go up to the top under My Trades, click on the Active Trades button, and it's going to bring us to this page. When we get to this page, we're going to see just the details for the day we're looking at the trade on. So tomorrow, we'll see just tomorrow's details. The next day, we'll see just that next day's details. So each and every day, I can manage all my trades from this one screen. And that's what makes this nice. So if I'm on here, what are our exit rules that we would be monitoring for? We all remember we're looking for a P factor, or we're looking for an early profit, or we're looking for what's called the proximity rule, if the market gets too close to one of our boundaries within the last week of the trade. So, having said all of this, let's go down and let me show you some actual active trades that have been going for a while that I've already got placed in this account for this training class, and let me actually show you how to monitor those trades. Okay, so here's some of those trades that I wanted to show you. So these are trades that were all set as paper trades, but they're still in the live market, and they've been going for a certain period of time. What I want you to look at here is what you're seeing is every single one of these trades. There's a total of 9 trades here, and you're seeing the data for each and every one of these trades. You're seeing the daily data. So if we look at the very top, we see this trade still has 16 days left. The one below it, in fact, those top 4 all have 16 days until they end. But they're all at different levels based on when we set these trades. If you look down here, you have 27 days left on all these trades, and the one at the very bottom has 44 days left. So this is going to look like a typical portfolio as far as how many trades you've got going. We want you to spread out your trading capital when you're using the software. We want you to spread it out and only put 1/10 of whatever you're trading in this into one trade. So you should always have about roughly 9 or 10 trades running in your account. So this one has 9, so we probably need one more to make sure we have about 10% of our capital into each trade. Now, the other thing here to look at is, what do we do to monitor these trades daily? How do I know that all 9 of these trades are doing okay and that I don't need to exit them? So let's go back through the monitoring process. Step number 1 for monitoring: make sure that the probability factor never reaches 40%. So where do we find that? We find that under this column, put and call. Under these 2 columns, you will see percentages listed. And those percentages are the probability factor for that day. So, if I'm looking at the put and the call, I notice that the put probabilities for those top 4 are less than 1%. The next 5 or 4 down, less than 1% there, less than 1%, less than 1%, less than 1%. This one's at 2.6%. So real quick, on all of my trades, are my puts okay? Those put options, they are. None of them have got a 40% probability, not even close, not even remotely close. So all of those trades, those put sides of the trade, are fine. So the next thing we look at is the call side. How about the call side? The top 2 are less than 1%. They're completely fine. The next 2 are at 7.4%, so nowhere near 40. The next 2 are under 1%. This one's at 8.7, 5.1, and 11.3. So again, on the call side of my trade, do I have any issues? No. I have less than a 40% P factor on all of those as well. So, step number one, did I have a 40% P factor that would signal that my risk is too high and I need to get out of a trade? And the answer is no. All of these trades are completely fine. The probability factors are not elevated, not even close to 40. So right now, this portfolio is looking good. These trades are looking okay. The next thing we want to check for as part of our rule, or rule number 2 for exiting, was the profit. Anytime we can make an early or take an early profit, we make a large amount of profit in a short period of time, we still have a considerable amount of time left in the trade, then it might make sense to get out and move the money into another trade. So let's look at our profit. Over here we see a P&L column that shows the total profit or loss on the trade as of right that moment or for that day. And then I see something called return on target. And this is the number I want you to focus on. Return on target, 87.3% is what I've made of the 590 that I'm supposed to make as my target. So right now I'm at 515 realized of the 590. So that 87.3 just says I've almost got 90% made. But I still have 16 days left. If you remember my rules for profit directive, if I have 70% or more, I want to make sure that I'm still in a trade that has greater than 20 days. If I've got 70% of that return on target and greater than 20 days in the trade, I can pull out. But this trade only has 16 days left. So the next one was if I have 80% of the profit with greater than 10 days, then I can get out. So here's an example of a trade that I could get out of. This trade has 87% of the target made. It has greater than 10 days. I could close it out and roll that money into the money that's under deposit for that trade. I could roll it into a new trade and take this one off the table. As I scroll down, you'll see another one over 80. You'll see another one here that is over 100% of its target profit. This is utilizing a strategy called the Eagle, which I'll talk further about later in the presentation, probably tomorrow. But for this particular example, this one's already over 100%, so we could also close out of this. The other one's below. This one's at 33. This one just hit 70, and it's greater than 20 days, so we could get out here. Same thing here. This one here, not quite, and this one, not quite. The very bottom one, though, is probably the one that's concerning to everybody, because the top 8 are all profitable, but the 9th is losing money. As of today, the profit loss on the trade is about $310. So the question is, why is that trade losing money? Well, let me explain. And this is really important to understand this concept. Whenever you enter a trade, selling options and then buying options using this iron condor, you will always start out negative in the trade. And the only reason is you're trying to overcome your commissions and you're trying to overcome the up and down price changes of the options. And it usually takes a little bit of time for that, for the red to go away and the green to begin. So all the trades up top, they've been going for a while, and that's why there's not any red in those, and they're doing well. The bottom one was just recently set. And because it was just recently set, it's still in the red. Okay? Now if I click on that one, right here on the trade ID to look further into the details, what do I see? I see on this graph that the market is well within the boundaries. It is not close enough to the red one on the call side or the red one on the put side. So this is fine. There's not an issue. It's just that these trades take a little bit of time to turn green simply because of the commissions and what we call the time decay. So as time starts to decay and more time goes by and you've been in the trade longer, the trade's red will start to go away and then it should start to turn green as long as it's, the probability factors are where they should be. So that's an example of how you monitor trades for the first 2 rules. Rule number 1 was the P factor, making sure it's not higher than 40. Rule 2 was the profit. 70 or higher, we want to start looking at them depending on how many days they have left. And then lastly, the question that everybody asked me is, what about that proximity rule? When do I do that? When do I worry about that? Well, the proximity rule is based on how close we are to our boundary. So it's real easy to look at these prices here. Price 1999.8. And then I look at my call option, 2090. Am I anywhere near 2090? No. I'm almost 100 points below it. I'm nowhere near the put. If it was within 10 points of 2090 on this price, or 10 points, within 10 points of hitting the 1785 on this price, then we would worry about the proximity rule and we'd get out of the trade if we were in the last week. All of these trades, I can tell you very quickly, are nowhere near that number. So we're not going to worry about it at this point. The proximity rule does not apply. Now you can automate all this. We'll talk about that later, but you can set up auto exits so that if the proximity rule gets too close, it'll send you a trigger depending on what broker you're working with. Some of them can automate that. So again, that is monitoring the trade on a daily basis. So it's pretty simple. You simply log in here, take a look at all your trades, follow the exit rules, and if nothing needs to be exited, which is sometimes the case, then put it away and go through the process again the next day. Okay, what I want to talk about next is exiting the trade. So once I'm in an active paper trade and I want to exit the trade, maybe right in the middle of the trade, or I want to exit a trade that's reached a large amount of profit, or exit a trade that's hit a 40% P factor, how do I do that? What do I do? Well, there's a little red X that you're going to see on the software over on the right-hand side of the column or of the screen, and you're going to click on that red X to start the closeout or exit the trade. And then once you do that, you're going to review it under what's called the closed trade section. So anytime I have an active trade that's still active in the current market, it's still going, it still has time left, it'll be under the active trades page of the software. If it's over with and I've exited it, it'll be displayed in the closed trade section of the software, and we'll go through that in a minute. Okay, so let's actually exit one of these trades. Let me show you the process. So the trade that I want to exit right now is the one at the very top, or actually this one right here. It's at 101.8%. It's over 100%. This one is definitely one we want to get out of. There's some other ones, but I just want to show you this as an example. So to exit this trade, first I'm going to click on the trade ID. Now there is a quick link here that says exit that you can click on as well, but I always click on the trade ID right here, and I go into the actual graph of the trade so I can see what happened. And look at that. Wow. It got close to my boundaries on this trade, but it didn't reach them. So I scroll down to the very bottom of the trade, and I see a big button that says exit trade. Now, if I wanted to exit earlier on, I can see everything that happened in this trade from the very beginning. If I notice that this trade hit a 40 P factor, so if I'm going and back testing something that happened a year ago, I can go and examine this page and look at each day and see if I would have hit a 40 P factor or if I would have hit an early profit on any of these days. And if I did, I could click on the little red X next to that day to close out the trade. And that way it would actually close it out at the right time according to the rules, and it would store it and keep track of it in the closed trades section of the software. But for this example, we're just going to close it on this day at 102%. So we hit this little button down here that says exit trade, and we have the opportunity to go in and exit it. Now when you're exiting a trade, you have the chance to do what's called close out just part of the trade or all of the trade. In this particular case, we're just going to close out all of it because this is a profitable trade. I'll give you an example of closing out part of a trade later on. The other thing I'm going to do to exit this trade is, because this is a paper trade, I'm not going to adjust any of the numbers on the screen. I'm simply going to hit this button right here that says exit trade. As soon as I hit exit trade, this trade has now been exited on that date. It will now appear under the under the closed trade section of the software right here. So if I go in and click on this button, that's where I'll be able to go in and see that trade that I just closed out. And all it does is it stores it, shows you what the profit or loss was on the trade, and keeps a running tally of all the trades that you've done. Okay? All right. So that's how simple it is to close out an active trade.